morning, everybody, and welcome to this edition of our sustainability webinars. So this is the first webinar in a series of sustainability webinars in 2024. We've started the sustainability webinar series in 2022. So this is the third year that we're exploring sustainability on a monthly basis. I would like to begin by acknowledging the traditional owners of the land on which we meet today, and also pay respect to elders past and present. And we extend that respect to Aboriginal and Torres Strait Islander peoples that are here today. So my name, I'm Aletta Boshoff. I'm the national leader for ESG and sustainability at BDO, but also the national leader for IFRS and corporate reporting. It's really interesting that over the last 2 years, my two different hats have become closer together. There's a lot more overlap these days between sustainability and also IFRS and corporate reporting. So in a way, the two hats are sitting more comfortable on my head. Just a bit of a look at the webinars for this year. Now, we've scheduled the 12 webinars for the year, and we've tried to schedule them around the topics that we believe would be really important this year. So today we try and set the scene. We look at the latest developments around sustainability, in particular some developments in Australia. Then in February, we look at activating your sustainability strategy. We look at developing a sustainability roadmap in March. And then we look at carbon accounting, setting targets. In June, we look at the role of voluntary and mandatory reporting, just in time for June reporting season. Then we look at assessing climate-related risks and opportunities. How do we use climate-related scenario analysis to assess climate resilience? Then we look at processes and policies to manage climate-related risks. In October, we look at understanding relevant climate-related metrics. In November, setting climate-related targets, and finally, climate-related disclosures in December. So it's a whole jam-packed series of webinars really exploring sustainability and all the latest and greatest. And we hope you can join us for all these webinars. Now, we also have a long-running series of webinars around IFRS and corporate reporting. Believe it or not, it's the 8th year that we've been running this webinar series at BDO. Last week, we started by looking at what's hot and what's not hot in 2024. And you would be surprised or happy to hear that the number one item that's hot is actually carbon accounting and sustainability reporting. You can watch any of these webinars. If you missed it, you can watch the recording and download the PowerPoint slides. But this gives you an idea of what we'll be looking at from an IFRS and corporate reporting perspective, if you or anybody else in your organization would be interested to register for those. Now, for today's agenda, similar to what we did last year in the first webinar for the year, I would like to go back to a BDO board survey and share some insights from that survey. I then want to look at a CFO survey and share some insights from that. So that was done early 2024, so this month. Then I would like to move to a regulatory update with a very specific focus on Australia. Then we look at an update around sustainability reporting standards. We look at an update, we look at an update around carbon accounting. We look at an update around auditing and assurance. We look at an independence update. And then finally, next steps on developing a practical roadmap. Green, I've put it in bold because I would say most people are asking me about a roadmap. Most people are saying, Aletta, there's a lot of stuff happening. Can you help us? How do we get started? how do we get ready in time, and break it down into small little steps to achieve this big outcome. It does remind me quite a bit of if you say, how do you eat an elephant? You would say bit by bit. So I think that's really important to keep in mind here. If we look at the board pulse survey, so the board pulse survey as well as the CFO survey are both conducted by BDO in the US. And they contact these board members, they contact CFOs, they use an independent research company to do the research for them, and always fascinating findings. As I've said last year and in previous years, a lot of the time the findings from this US survey are very aligned to what we see in Australia, and I think this year no exception. So first of all, I thought I'll give you a link to the board report if you want to read it. Obviously, I'm focusing on the sustainability and the ESG aspects, but there are other interesting aspects within the survey as well. One of the things that I thought what was really interesting is they asked the question, where could the board be more impactful in its oversight of management? And you can see there the winner, strategic innovation, proactive anticipation of disruption was a clear winner, around human capital strategy, executive and employee compensation benefits, transaction due diligence integration, stakeholder and activist engagement, and then also disclosure, compliance and transparency, and then at a low number, but I think it's still there as one of the key things, is integration of sustainability into corporate reporting. And I think that's what I've said earlier, where the two hats that I wear become closer. You'll see later in the presentation, sustainability and the sustainability report is given prominence, equal prominence to the financial report in the annual report. And therefore, it enhances the integration of sustainability information and the impact it has on overall financial performance as reflected in the financial report. So I think that integration is something that we should not forget. And then also a question around how have ESG initiatives benefited your organization so far? Now, a lot of people focus on the additional cost and the additional time. So this was an interesting one. How have ESG initiative benefited your business? Not just it's benefited the business, how has it actually done it? 33% said it's reduced supply chain risk. 32% have indicated that it created new or innovative revenue streams. And I think that's a very interesting one, because we often talk about sustainability around risks and opportunities. And if we see that 32% indicated that it created new or innovative revenue streams, that would support that opportunity aspect. It reduced cost. Now, we often talk about it, that if you do sustainability and ESG well, it would reduce cost. And there we have some evidence. 22% indicated it reduced cost, a reduced energy transition risk, improved customer retention attraction, improved our ESG rating, improved employee recruitment. So these are feedback from boards on how these initiatives, broad ESG sustainability initiatives, has had a positive impact on the business. Then I think this was really interesting. 27% of directors, board members, believe environmental issues will be top of the shareholders' minds in the upcoming proxy season. So that was at the end of 2023. So that's a large number of people focusing on environmental issues. Then also they asked the board, when asked which ESG focus areas will provide long-term sustainable value to the organization. So which of these things will provide long-term sustainable value? 31% of directors cite bolstering environmentally friendly policies, procedures, and products. And 27% cite reducing carbon footprint and satisfying net zero emission commitments. So again, a big focus on the environmental side, and we know shareholders are interested in this. I think the other thing, a BDO perspective, after they do the survey, they add a bit of a perspective or commentary, and I've highlighted in yellow some of the key things. Boards will be closely monitoring the implications of the SEC or in Australia, what the Australian Accounting Standards Board, Australian Treasury will be doing around disclosure of Scope 1, Scope 2, Scope 3 emissions. And even boards that don't recognize climate risk as salient to their business yet will likely need to procure and disclose data from their own carbon footprint, as well as supply chain sources, or in response to other companies' requests if part of their supply chain. And we see that in Australia. We've often talked about that. Mandatory reporting for the big end of town, for those Group 1, Group 2, Group 3 entities, that's one thing, one piece of the puzzle. But any entity, smaller entity that's within that supply chain will also have to calculate, capture, report at least to key stakeholders their carbon footprint. So a big emphasis on carbon footprint, measuring your carbon footprint, carbon accounting. And then I think the final observation, and we see this with our clients, preparation for regulatory compliance will take significant time and effort. So that's the board pulse survey towards the end of last year. Clearly, boards are aware of this. Clearly, boards are aware of the regulatory aspects, aware of the environmental aspects, which is the first focus area, and it's on their agenda. The CFO Outlook survey, again, I had some expectations, and it was interesting to see what came out of this report. So my expectation and what I've seen in Australia is in previous years, we often met with sustainability experts that's been doing amazing work over many, many years. But it's been difficult to really engage with audit and risk committees, engage with finance teams, engage with CFOs. Now that we've got regulatory compliance coming, we've got assurance coming, I think the conversation has changed. CFOs really interested. They know it's their responsibility, and they know it has to go in this annual report. And also strategically, how do you manage the risk of being left behind if you're not measuring your carbon footprint and providing it, for example? So I know in Australia, CFOs heavily focused on sustainability, and in particular carbon accounting and sustainability reporting. So this survey done in the US, so the title, Middle Market Prioritizes Stability, and their key 3 takeaways from this report is many CFOs expect revenue and profitability to remain flat in 2024, and they share how they'll go on the offense to kickstart their growth. In the second one, how thriving companies see sustainability issues as an opportunity, not a constraint, and what's driving their sustainability investments. So I think that links really nicely on the strategic aspect around sustainability. So this is not all risk, not all compliance, but there's actually strategic opportunities for a number of entities. And then also CFOs are embracing generative AI and their journey to explore its limitless potential to transform the business. And I know we also have a number of partners in our technology teams that look at that. So one of the interesting insights, the greatest risks to your business in 2024. So what did the CFO say? Interestingly, economic volatility, 40%. But look there in the middle, ESG risks, greatest risk to the business, ESG risk, 37%, really high. So CFOs are aware of the risks, but also want to explore the opportunities, similar to the boards. Then also indicating that ESG strategies are gaining momentum. to manage the risks and to explore opportunities. So 53% of CFOs say they've embedded ESG principles into their core business strategy or are actively working on it. So do you incorporate ESG principles, sustainability principles into your business strategy? 53% of these CFOs already do. Then we asked them around anticipated CFO involvement in 2024. And there you can see, when you look at ESG strategy and execution, 75% will maintain or increase their involvement in that space, the highest area. A number of other areas, but ESG strategy execution, CFOs expect to be heavily involved, and they will actually increase their involvement. I think that's very telling. And then maybe just coming back to one of the key takeaways, thriving companies see sustainability issues as an opportunity, not a constraint. And therefore, because they see it as an opportunity, CFOs want to build it into their strategy. So it's not just about risk, it's also about opportunity. So really interesting insights from what boards are telling us, but also what CFOs are telling us, specifically in relation to sustainability and ESG. Both of those reports are available and you can have a look at that. So that was a bit of an introduction. A regulatory update. Now, this year has really started with a bang because I think most of us were back at work on the 8th of January, Monday, the 8th of January. And then on Friday, the 12th of January, Australian government released the draft legislation to bring about significant reforms, establishing climate risk disclosures in Australia. So in the past, so in December 2022, in June 2023, Australian government and Treasury released consultation papers. This is now getting to a near final stage because it's draft legislation. And they are proposing, and they've shown, and they've put out for comment, draft legislation that amends the Australian Securities and Investment Commission Act 2001 and the Corporations Act 2001. And what they'll be introducing through this draft legislation and soon to be final legislation is a separate sustainability report as part of an organization's annual report. So this sustainability report is now getting a lot of prominence. I often say that the financial report is getting a sibling, the sustainability report, with equal prominence in this annual report. Also, from day one, that this sustainability report is part of the annual report, entities will be required to obtain an assurance report, not a full audit, but an assurance report over that sustainability report. And very interesting, I've actually underlined it, and I've got it in bold and in red. They have to get assurance from their financial auditors. So what we're seeing here from the draft legislation, it looks as if that if you have financial auditors for your financial report, the same auditors will be providing assurance over the sustainability report and also audit of the remuneration report, which is part of the director's report. So the same financial auditors. So it's the first time that that particular aspect has been articulated in the draft legislation. This is a slide explaining or trying to flag all the different pieces of legislation or draft legislation. So there's an explanatory memorandum and impact analysis, etc. And the comment period is next Friday. So who will be required to do climate-related reporting in this separate sustainability report in the annual report? So they've confirmed the three groups. So group one, if you meet two of the three criteria, and it's looking at revenue, end of financial year, consolidated gross assets, and end of financial year employees. Consolidated revenue obviously runs for the whole financial year, But if you look at gross assets and employees, it's the position at reporting date at the end of the year. If you meet 2 of the 3, you fall into Group 1, Group 2, Group 3. And noting that Group 3 would be the entities already lodging audited financial statements with ASIC. So it will ultimately expand to all entities in Australia preparing and lodging audited financials with ASIC. There's a separate column that deal with our ENGA reporters under the ENGA Act, and therefore if you're above the ENGA publication threshold, you'll be Group 1. If you're Group 2, you'll be all other ENGA reporters, and we don't anticipate any of them being in Group 3. And then there's also an additional column dealing with asset owners. And asset owners, where they've got more than 5 billion assets under management or more, they will be in Group 2. So what does that mean? What does the groups mean? The groups give you an indication on when you have to prepare your first annual sustainability report as part of your annual report subject to assurance. And you can see for Group 1 entities, we're talking about years beginning on or after 1 July 2024. Therefore, for most Australian entities that have a June year end, it will be 30 June 2025 annual report. 2 years later, we're looking at Group 2 and another year later for Group 3. So there are a number of entities that will be excluded from this mandatory climate-related reporting. So obviously, small and medium businesses that are below this size threshold will be exempt. And then there are some entities that are exempt from lodging financial reports under Part 2M of the Corps Act. For example, when those entities have ASIC class orders, then they'll also be exempt for the sustainability report. And where the entity is registered with the ACNC, they'll be excluded. Please note, it's not an exclusion for all not-for-profits. It's only those registered with the ACNC. I think the other thing to add, and this is a new addition to what we've had in the previous consultation papers, and that is the Group 3 materiality exemption. So Group 3 entities, so the entities that are in scope for reporting but do not meet the thresholds for Group 2. So Group 3 entities, that's the entities that have a bit of extra time. They would only be required to make climate-related financial disclosures in line with these climate disclosure standards, so IFRS S2, as amended for Australia, if they face material climate-related risks or opportunities for the financial reporting period. So there's a materiality test for them. Where these entities assess that they do not have material risk or opportunities around climate, they would only be required to disclose a statement to that effect. So this is an interesting exemption because in order to assess that you do not face material risks or opportunities, I think entities will have to do quite a bit of work in order to justify why it's not material. And then, practically once you've done all that work, why not disclose it? I think this will be interesting. The other thing is, given how the economy is moving, given the importance and the flow-through effect of decarbonisation of the economy, it seems quite unrealistic that there would be entities arguing that this is not a material risk to them. And maybe I'll try and explain that view by looking at this slide. We've previously discussed that if you look at carbon accounting and measuring your carbon footprint, and we know there's scope 1, scope 2, scope 3, we know that between 80 to 90% of the carbon footprint of most entities are in scope 3. Scope 3 is the carbon or the emissions that is brought to an organization through the supply chain. So it's the carbon emissions embedded in acquired goods and services. It also, so that's upstream, it's also the carbon emissions downstream. So what happens to the product or the service once it leaves the organization? So if we've got group 1, group 2 entities doing mandated calculation and reporting of carbon footprint, setting targets, they cannot do that without the input of the upstream suppliers or the downstream customers in order to get that complete picture of scope 3. And scope 3 is 80 to 90% of their footprint. So therefore, even smaller entities, if they want to continue to be a supplier to these large entities, if they want to continue to do business with them, they'll have to measure their carbon footprint. They'll have to set targets. They'll have to report on those, maybe not in their annual report under a regulatory environment, but they will have to provide that information to their customers, to keep their customers, to help their customers to achieve their targets. So I think smaller entities have to be very careful. They are not out of this. This is something that they have to think about strategically. And I always say to smaller businesses, and actually all businesses, you have to think, where do you fit into this economic system? We know sustainability is about access to capital, markets, and people. So where do you get your capital from? And will you be able to get that equity, debt, donations, whatever capital from if you do not have a carbon footprint, if you do not set targets, if you do not report on your progress? So strategically, will you be able to get capital? Will you be able to have customers in your markets? And will you attract people to work in your business? So where do you fit in the system? Read the room. Who are your key stakeholders, right? In this economic system, who are these key stakeholders that are important to your business, its existence, its strategy? What are the risks, the opportunities? These stakeholders, what information would they need to meet their commitments, which might be regulatory reporting commitments? What would they demand? And I suspect carbon footprint net zero targets is like a minimum they'll demand. And are you ready to provide this information to stakeholders? So if I go back to the previous slide, I know there's a group 3 materiality exception. In practice, difficult to apply, difficult to assess. And having looked at this discussion, I don't know whether this is something that you could really argue is not a material risk practically. What will be disclosed? So the legislation will mandate climate reporting in Australia. They're trying to, and they say we endorse full adoption of IFRS S2, but please note right at the end of the sentence, with modifications limited to those necessary to ensure standards are fit for Australia. Now, I've got a concern over that, and my concern is if Australian entities are complying with Australian standards around climate reporting, that should also automatically put them in compliance with IFRS S2. Otherwise, a lot of entities that are global players that attract capital, customers globally will anyhow to do all of this work for IFRS S2, because globally they would be looking at IFRS S2 and not whatever we have in Australia. And we've seen that with accounting standards in 2005. So I've got a bit of concern with that. If in Australia we have additional disclosures, not too much, but additional disclosures for the Australian environment, additional to IFRS S2, I don't see that as being a problem. But if we have less disclosures, entities will struggle to also comply with IFRS 2. And obviously, if the requirements of the Australian standard is contradicting or in contrast to some of the requirements of IFRS 2, that could be problematic. So I think we should try and avoid that. Then also, they've said it should incorporate Australia's greenhouse gas emissions estimation methodologies and international climate change commitments. And then the last one, they support the adoption of IFRS S1 to the extent that it impacts climate disclosure standards. So really IFRS S1, which is usually looking at the broad sustainability spectrum and identifying which topics is relevant for Australian entities, is really been cut down to say, just look at climate. So hopefully at some stage we'll also look at the other topics and do a proper stakeholder materiality assessment. I think a number of entities already will not limit themselves just to climate, because they are seeing that there are other sustainability areas that's important to retain staff, to attract staff as part of their strategy. But from a mandatory reporting at this stage, only limited to climate disclosures. So what will this look like? This new sustainability report will sit within the annual report. It's one of 4 reports. There's an annual financial report, annual sustainability report, a director's report, and an auditor's report. So those are the 4 siblings. So the annual sustainability report, very prominent next to the financial report, and this would allow for integration of the impact of sustainability on the financial report. If you put the 2 next to each other, the Corps Act is proposed to require the sustainability report to consist of climate statements, notes to those statements, and the director's declaration about the statements and the notes. Now, those requirements are very similar to the requirements we already have for the annual financial report, where we've got the statements, we've got notes explaining our accounting policies, and we've got directors' declarations. And the timing, these 2 reports are prepared, lodged at the same time. So you can see the financial report, sustainability report, very similar next to each other, equal prominence, really big move. Around assurance, again, I just want to articulate that entities will be required to obtain assurance from the very first period. There was some discussion, will there be delayed assurance? No, from the first year assurance, and by 2030 full audit by their financial auditors. And these financial auditors will use technical climate and sustainability experts where required to assist them, the same way they use auditors, experts to help them in other areas when they conduct audits. So really important that we get auditors to do the auditing. They understand the auditing and assurance standards. They've got the experience, and we get the sustainability experts to assist as an expert, joining the engagement teams. And then we're expecting Australian assurance standards, and we've seen a draft being issued internationally already. The other one that's interesting is for modified liability, and that is that for a fixed 3-year period, disclosures relating to Scope 3 emissions and certain climate-related forward-looking statements. So only 2 areas, Scope 3 and certain climate-related forward-looking statements will be subject to this modified liability. So for a 3-year period, for reports between July 25 and June 28, only the regulator, ASIC, will be able to bring action relating to breaches around disclosures of Scope 3 and climate-related forward-looking statements, and the remedies available to the regulator will be limited to injunctions and declarations. Now, beyond this point, or beyond this period, the existing liability arrangements will apply. The existing liability arrangements will also apply to other items in the sustainability report, so that would mean Scope 1, Scope 2, etc. I've mentioned earlier that it's really important to link information in our sustainability report with information in the financial statements, because sustainability information could have an impact on asset values on liabilities. So the fact that we've got the sustainability report, the light blue box, and the financial statements, the dark blue box, together in the same annual report next to each other would really allow for that integration. And then over time, that grey box where we've got all the other sustainability topics they would slowly move over to the annual report as IFRS S3 to, let's say, S25, S30 will be issued over a number of years. Currently, a lot of organizations prepare a separate sustainability report, similar to BDO. We have a separate sustainability report. It's that gray box, and that can stay there. We can have that separate report. I think it will be interesting, what do we name that separate report? Because how can you have a sustainability report in your annual report and another sustainability report outside the annual report with other information? I don't know, do we call it a supplementary sustainability report? Because that supplementary sustainability report will become smaller and smaller over time, and the sustainability report in the annual report will become bigger and bigger over time. I think the other thing that I thought would be good at the beginning of the year to give a bit of an update about is, if you look at sustainability reporting standards itself, and now we know the International Sustainability Standards Board did a lot of work to coordinate the work of a number of standard setters, bring them all into the International Sustainability Standards Board, and they've also used the work that these standard setters bodies have done in the past. For example, the TCFD, they're now part of the ISSB, and they've used the TCFD recommendations as the foundation for IFRS S2. So the International Sustainability Standards Board have done a lot of work to harmonize and bring together standard setters. And then after a short period of time, I think it was about 20 months after they've been created, they issued their first standards in June last year. So IFRS S1, and I think the easiest way to explain IFRS S1, it is the starting point. That's where you say there's a lot of sustainability topics. Which of them are important to our stakeholders, not shareholders, stakeholders, and to our business, and we'll focus on them. So it's a materiality assessment across the topics, stakeholder engagement, really the starting point. IFRS S2 is then the first of a series of standards dealing with all the possible topics, and you'll only apply all these topics if it's material to your business. But globally, in Australia, everybody's saying this is material. Climate-related disclosures is material. We expect targets, etc. So we've got IFRS S2 in Australia, issued globally in June last year. What's then happened, in October last year, the Australian Accounting Standards Board issued one exposure draft where they look at Australians' sustainability reporting standards, and they initially just focus on climate-related financial information, which is aligned with the draft legislation that we've seen by Treasury in January. Treasury is saying just look at climate-related disclosures, and therefore the AASB in their standard setting have only focused on climate-related disclosures. So they've said we're not putting in IFRS S1 yet because we're just focusing on climate-related disclosure. So the comment period for this is the 1st of March, that we have to provide feedback. I think what's interesting is if you look at IFRS S2, and even if you look at the exposure draft for Australia, it's very clear that it's not just an exercise of these are the disclosure requirements and we put it in the financials. There's a lot of work that has to be done to generate the information to go into the sustainability report to meet these compliance requirements. So, for example, you have to come up with a carbon footprint. You have to come up with a roadmap, a low carbon transition roadmap. In order to do that, you have to set organizational operational boundaries. You have to look at your scope 1 and 2 and 3 inventory. You have to get some verification or assurance over it. You have to think about data. You have to think about systems, processes. So really important, there's a big body of work around carbon accounting and decarbonization, big body of work, and usually the first place. And then that results in disclosure. And then the other piece that I think a lot of people forget about is there's also a requirement to do a climate risk assessment, a climate risk and vulnerability assessment, look at a scenario analysis, look at forward-looking scenarios, identify mitigation and adaptation strategies, and then come up with climate risk implementation frameworks and recommendations. So I think there's two huge projects that will have to be run by organizations in order to get ready for that first report. So yes, we know what has to go in the report, but what projects do we have to run in order to prepare that report? I think that's important and often overlooked. I've said carbon accounting is critically important. It's usually the starting point. I just wanted to flag some aspects that we're grappling with at the moment. So IFRS S2, remember that's a global perspective, is saying in paragraph 29, an entity shall disclose information relevant to the cross-industry metric categories of greenhouse gases you have to disclose, and you have to go and look at scope 1, scope 2, scope 3. And then in the last paragraph on the screen, and this is just a screenshot from the standard, it says you have to measure greenhouse gas emissions in accordance with the Greenhouse Gas Protocol, a corporate accounting and reporting standard. And we had a series of 6 webinars last year where we worked through the Greenhouse Gas Protocol, or did a bit of an introduction to what that means. That's the foundation of how you measure your carbon footprint. But they do say there, and this was added fairly late in the piece, it wasn't in the original drafts, unless required by a jurisdictional authority or an exchange on which the entity is listed, to use a different method for measuring its greenhouse gas emissions. So if there's a jurisdictional authority like ASIC or Treasury, Australian Treasury, or an exchange like the stock exchange, and they want us to use something different to the Greenhouse Gas Protocol, that could be done. So, all right, so that is there. But then if you look at the application paragraphs, it talks about in paragraph B24, you can use this other method, different to the Greenhouse Gas Protocol, for as long as the jurisdictional or exchange requirement applies to the entity. So as long as Treasury says, or ASIC says, we can use something else in Australia, we could. All right, that's what they're saying in paragraph B24. Paragraph B25 is an interesting one. It says, in some circumstances, an entity might be subject to a requirement in the jurisdiction in which it operates to disclose its greenhouse gas emissions for a specific part of the entity or for some of its greenhouse gas emissions. For example, only scope 1 and scope 2 greenhouse gas emissions. All right? So you only have to do 1 and 2 under a certain jurisdiction and using a certain legislation. In such circumstances, the jurisdictional requirement does not exempt the entity from applying the requirements in this standard, IFRS S2, to disclose the entity's scope 1, scope 2, scope 3 greenhouse gas emissions for the entity as a whole. Now, while I'm flagging this paragraph, it raises some questions for me on how this will apply in Australia. Because in Australia, the ED by the Australian Accounting Standards Board says, we have to disclose greenhouse gases, scope 1, 2, and 3. However, in paragraph B of this Australian specific standard, it says, measure your greenhouse gas emissions by applying relevant methodologies set out in the ENGA scheme legislation to the extent applicable. And if you look at that ENGA legislation, ENGA is looking at scopes 1 and 2. And therefore, there's no requirements around scope 3. And then if you go and look at scope 3, you'll revert back to the Greenhouse Gas Protocol. So it's an interesting aspect. If we do this for Australia, if we do scope 1 and 2, under the ENGA Act, Scope 3 under the Greenhouse Gas Protocol, would that mean that we are automatically in compliance with IFRS S2, specifically if you look at paragraph B25, which says if you are limited to certain scopes in your jurisdiction, you still have to do Scope 1, Scope 2, Scope 3, potentially in accordance with the standard? Does that mean under the Greenhouse Gas Protocol? So will we have two carbon footprints? So that's an interesting aspect that we will raise in a submission that we're exploring, discussing, but I wanted to put it out there. To date, the ENGA Act has been applied by the real large reporters, a small group of reporters in Australia. So if you're another entity that are now going and looking at carbon accounting, it will be really important to consider, do you do ENGA Act for Scope 1 and 2 and then Greenhouse Gas Protocol for Scope 3, or do you do ENGA Act for Scope 1 and 2 and also Greenhouse Gas Protocol for Scopes 1, 2, and 3 because you want to be able to state compliance with IFRS S2 because you're a global player or attract capital globally? So that's a little bit of a question mark. I didn't want to hide it. I thought I'll throw it out there. So if you want to look at the Australian legislation, the ENGA Act, the National Greenhouse and Energy Reporting Act that was issued in 2007, there's a link there on that slide, and it's also supplemented by the National Greenhouse and Energy Reporting Regulations 2008 and onwards. So ENGA seems to be the way that the AASB will go around Scope 1 and 2. So please don't ignore that, and we'll address it as well going forward. The Greenhouse Gas Protocol is the protocol globally used most often. It's reporting framework agnostic. The idea was whatever framework you pick, the measurement is under the Greenhouse Gas Protocol. And this is what we've discussed in our webinars, and these are the standards. And we also have a video publication looking at it at a glance. And we had our 6 webinars last year exploring the Greenhouse Gas Protocol. So to be fair, I was surprised to see that in Australia, all entities will have to apply the ENGA Act for Scope 1 and 2, because I'm worried that that puts us at a bit of a difference between us and global expectations and global IFRS S2. But we're exploring that. Assurance update. I think it's important now that we know that assurance will be required from the very first year that you do mandatory reporting. Last year, the International Auditing and Assurance Standards Board issued an exposure draft in August. A new proposed assurance standards, ASAE, it's an international standard, 5000 in Australia, expected to become AESE 5000. And there's an explanatory memorandum on what auditors will be expected to do across assurance and when they look at carbon accounting, sustainability information. Then independence. I think this is an important one. And actually on Monday this week, on the 29th of January, the International Ethics Standards Board for Accountants on Monday issued an exposure draft and an explanatory memorandum around sustainability assurance. So now that we've got mandated reporting, we have mandated assurance over that reporting, important to understand from a professional services firm perspective, what are the restrictions or limitations? So when the audit firm is providing assurance over sustainability information, to what extent can consulting and advisory provide other services to that client? As you know, in our code of conduct, we've got very strict rules on if an audit partner at BDO does the audit or assurance for a specific client, then I'm an advisory. there are very strict rules on what I can do for that client, and there's certain things that I just absolutely can't do, and certain clients I can do nothing for. So the whole sustainability area, there was no specific guidance. As of this week, we've got some guidance on what's allowed and what's not allowed. It's an exposure draft. It's not a final standard yet, but it's really important that we get this so professional services firms have clarity on what they can and can't do. And I think organizations would be interested in that as well. So then next steps, maybe to end up, next steps, most clients would phone and say, Aletta, this is overwhelming. You talk about a lot of stuff. You know, how do we get ready? What is a practical roadmap? Now, I've shared this last year as well, but I want to share it again to discuss. So first of all, sustainability covers a lot of areas. Mandatory reporting is only climate change, which is one aspect of the environment at the moment. All these other topics, we expect IFRS S3 and more over time. IFRS S1 globally is trying to say which of these topics is relevant to your business, but it looks like in Australia that would not be a mandatory requirement. My challenge would be strategically, can you ignore that? So let's look at a best practice roadmap for Group 1 entities. So those are the entities that for 30 June 2025 will have some mandatory reporting obligations. So the green blocks would be when it's mandatory. So this is a Group 1 entity. For 30 June 25, there will be mandatory calculation and reporting of Scope 1 and 2 emissions. And then in 30 June 2026, mandatory calculation and reporting of Scope 3 emissions. So they've got an extra year to get ready. So we've got three streams here. We've got the first stream is all about carbon footprint measurement, which is where most entities start, and where I think entities should start. We distinguish between Scope 1 and 2 because it becomes mandatory earlier, and Scope 3, which has a year delay for all the different groups. We are suggesting that entities look at an initial calculation for 30 June 24, look at setting targets at the end of 30 June 24 based on that information, and also conduct an assurance readiness assessment. So when the auditors arrive next year, will you be ready? Would you be able to pass that assurance experience? For Scope 3, although there's a year delay, we believe you should start with that initial calculation as soon as possible, because there's a lot of learning, a lot of estimation. You have to engage your suppliers and your customers. This is problematic. You have to set targets. Then in 30 June 25, you can have another calculation. You don't have to disclose it externally, but you fine tune, and then you look at assurance readiness. And then a year later, you include it in your report. The second stream is the one that I've referred to earlier, and that is that climate-related disclosure, which is driven out of a climate risk assessment, a scenario analysis, etc. So I would, for 30 June 24, include all TCFD disclosures in the annual report. Great stepping stone, only 11 recommendations. And then from 30 June, you won't have that as a TCFD disclosure. It will now be an IFRS S disclosure, and IFRS S2 will build on it. So in 24, I'll conduct an IFRS S2 gap analysis and identify the projects that you have to conduct to get ready for 30 June. All right, identify the projects, not just what do I have to disclose, what not, where am I going to get the data from, who's going to do it, but also conduct an Australian sustainability reporting standard gap analysis. Because there's some concerns that we might have differences between IFRS 2 and the Australian version, and you have to think, you'll have to comply with the Australian one, but also do you want to do additional work to comply with the global one if you've got global activities? The last stream, the general sustainability disclosures, is actually the IFRS S1 concept, which we're expecting to be mandatory globally 30 June 26. We're hoping Australia will bring it in mandatorily quite silent about it at the moment. But I think strategically important to look at what's your governance around this, what's your strategy, what do your stakeholders want, materiality assessment. Think about risk assessment targets across the broader topics. So focus is number one, carbon footprint, number two, climate related disclosures, and then number three, the last priority is the general stuff. If you look at a mandatory perspective. But for a lot of businesses, that general sustainability related disclosures, although it's not mandatory, is so important for them strategically. Now, what we usually do is we start with this with clients, and then we explore what they've already done, how we can supplement, and then we break it down into a quarterly or a monthly plan. So you've got a very clear plan up to 30 June 24 over the next 5 months, what's going to happen every month. Up to 30 June 25, what's going to happen on a monthly basis, but also who's going to do it. Will I be assisting you, or will you have internal people doing the work, or how's this going to work? So really important to have a plan around timing and allocation of people, internal and external. This is a lot of work. I'm so happy to discuss that with you. Please reach out. Remember, we've got 3 TCFD training. We've got a free TCFD checklist. So how can BDO help? Obviously, we would love to help. The first way we help is by regular education through these webinars, as we've been doing for a long time. But we've got 4 core services around sustainability. We do work around carbon accounting. We do work around sustainability reporting, the voluntary one and the mandatory one. We do work around sustainability strategy and transformation, and we do work around sustainability assurance. And we are very careful that if BDO provides sustainability assurance, that we look very carefully to the new ED on whether we're allowed to assist around carbon accounting, sustainability reporting, and sustainability strategy. So these are the sustainability webinars that you can register for, and you can see we step through all these topics that will become an issue. You can register for our regular sustainability insights through a regular monthly newsletter. We've got e-learning that's available, and then we've got some key contacts across Australia if you need some assistance. So please feel free to reach out. I apologize for going a little bit over, but I've started late due to these technical bugs. I really hope I can sort out the IT stuff before next month. Thank you for bearing with me and staying the course. I hope you have a wonderful day. Thank you very much for your time today. Goodbye.